Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at a high dividend paying company that has a current yield of 6% and pays out cash to their shareholders every single month. And according to Morningstar, this stock is considered to be cheap or undervalued at this current point in time and may make a nice addition to a high income portfolio. And the company we're going to take a look at today is ticker PBA, which is Pembina Pipeline Corporation, that currently trades for $32 per share and is up by 25% on the 1-year chart. We can see right now the company has a market cap at $17.8 billion with a current dividend yield of 6%. And like I mentioned, they pay out this dividend every single month. So if you're looking for some consistent and monthly cash flow into a dividend portfolio, this is definitely a company to take a look at. And in this video, we're going to go over their recent financials, the dividend safety, and some future growth expectations over the next few years. But before we do that, I'm going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos. And today, we're going to focus on a high monthly income producer in Pembina Pipeline. So currently the stock trades for $32.40 per share, and if we take a look at a Morningstar report, they have it ranked as 4 stars, which is considered undervalued. And currently, the estimated fair value per share is at $35.58, meaning the company currently sits around 10% below the estimated fair value. And of course, throughout 2020, the entire energy sector did get hit, and Pembina's share price did see a significant drop, but from the low point, it's been consistently recovering and is approaching the pre-pandemic level. And recently, the company just gave an update for the first half of 2021, and they're performing very well, and the company's actually seeing growing momentum and a lot of future opportunities to expand their portfolio throughout the end of this fiscal year. And we can see some key highlights are that volumes across their pipeline and facilities division have consistently grown and are actually exceeding pre-pandemic levels, which is a great sign to see. And they've actually laid down over $400 million worth of assets so far this year, which is really impressive because the company was not forecasting much growth because of the uncertainty on the different labor restrictions due to the 2020 pandemic continuing at the start of this year. And as energy prices have continued to climb higher over the past few months, Pembina has seen continued strength in recovery in their conventional pipeline business. And physical throughput for the second quarter of 2021 is expected to be 3% higher than the first quarter and in line with the pre-pandemic level, which is a very strong sign. And we can see going forward, the entire global energy sector is projected to grow dramatically by 2024, and we're seeing an expected increase by around 19%. And across many different types of energy, they're forecasting continuous annual expansion, and Pembina has the infrastructure in place to capitalize on these growing opportunities and to expand their business and become a larger player in the mainstream pipeline industry within North America. And if we take a look at some business fundamentals, they have a strong BBB credit rating with $2 billion of liquidity as of the last quarter. And they've maintained and grown their dividend since 1998, so for around 23 consecutive years, and currently have a payout ratio of only 61%, and 72% payout ratio on fee-based distributable cash flow. And right now in the pipeline industry, these are the companies with long-term contracts to further throughput in their revenue for years to come. So owning a pipeline stock is a little bit different than owning a traditional oil player like a Chevron or an Exxon. And we can see the company had a 94% fee-based contribution rate to the 2021 adjusted EBITDA, and they're diversified across 200 different counterparties, and their top 20 customers accounted for 70% of the total revenue. And over the past decade, they've seen some pretty incredible results for a boring pipeline company. Their adjusted EBITDA is growing at a CAGR of 12.2% per year, which is absolutely phenomenal. Their adjusted cash flow per share is growing at 9.8% per year, and their dividend per share is growing at a CAGR of just below 5%. So year after year, your monthly passive income continues to grow. And if we actually take a look at that dividend, the current yield at the company at this current point in time comes in at 6%. Their payout ratio looks extremely high at 105%, but I'll explain why in a second, and their 5-year dividend CAGR comes in at 7%. And when you're looking at a pipeline company, this payout ratio uses their bottom line or their net income. And that's not an appropriate metric to determine the cash flow payout ratio for a company as a pipeline operator. And if we jump over to Simply Safe Dividends, currently the dividend is considered safe, coming in at an 80. So right now, even though the net income payout ratio looks extremely high, the dividend is still considered safe. And a better metric to use is the dividend payout ratio with the distributable cash flow per share. And of course, when you take that into consideration, the payout ratio right now sits at only 61%, which is actually considered low for the pipeline industry, and that shows Pembina is actually in a pretty solid financial position to continue to make that monthly payout over the next few years. And they've gone 22 consecutive years without a reduction in their dividend, which is a great sign. And right now, Pembina's 5-year dividend CAGR sits at 7%, and over the past 2 decades, their annual dividend growth rate is at 5% per year. And we can see over the past 20 years that annual payment per share continues on an upward trend, and the company's current dividend growth streak sits at 9 consecutive years. So Pembina Pipeline is definitely a company in the energy sector to take a look at if you need some high current income on a monthly basis flowing into your portfolio. Ticker PBA has recovered 25% over the past year, but is still trading below the pre-pandemic levels. And now we're going to take a quick look at the company's financial statements and go over some future growth projections of their revenue and their earnings over the next 5 years. So we can see right now, before the pandemic, year after year, the company's total revenue is growing at a pretty significant rate. $3.1 billion of total revenue, up to 4.3, then 5.3, 5.5, then of course year end 2020, we did see a pretty steep decline back down to $4.8 billion. But overall, before the pandemic that pretty much destroyed the energy industry hit, the company was doing a great job of expanding year after year after year. And overall, in the past 12 months, their revenue has recovered to around $5.2 billion. And if we take a look at the revenue on a quarterly basis, for Q2 2020, right at the start of the pandemic, when every company in the world was cutting costs and was worried about a major economic collapse, Pembina generated $934 million of quarterly revenue, which of course was a major decline from Q1 of 2020. But we can see from that low point in the worst quarter in the company's recent history, a consistent upward trend from $934 million up to $1.17 billion, then $1.33, and now $1.62 billion in the past quarter. In March 2021, the first quarter of this year is actually much higher than the same quarter back in 2020, which is a great sign. So from the low point through the height of the pandemic, when the entire energy sector did take a major hit, Pembina has been continuously rising and recovering, which is solid to see. And if we take a look at their cash flow statement, it's similar to the revenue. If we take a look at the cash flow from operations, which shows a company's ability to generate cash from their core and underlying business. So how the company actually makes money and how they generate cash is from their operating activities, and that's the fundamental and the core of the business. So if this number is growing year after year, it's a very good sign. And we can see in 2016, $800 million of cash flow from operations, then $1.2 billion, 1.6, 1.9, then of course 2020 hits and a little bit of a decline back down to 1.7, but of course in the trailing 12 months we have seen a recovery back up to 1.82. So similar story to revenue, their cash flow from operations, so that means the company's underlying businesses, they operate in 3 different segments, are growing year over year and generating more cash than the prior year, which is a great sign. And I think after we get out of the pandemic fully, we continuously see a recovery over the next few quarters. The company will grow their revenue and their cash flow for long into the future. And taking a look, analysts are forecasting 20% growth in the total top line this year. And in 2021, that means $7.7 billion of total revenue. Then following in 2022, we're up to $9 billion in total expansion from now over the next 2 years of 45%, which would be absolutely phenomenal. And if we take a look overall, analysts are forecasting some pretty significant growth from this pipeline company. And they're expecting 24% annual expansion each and every year for the next 5 years. And currently, the stock is considered a buy coming in at a 2, and the share price of $32 is well below the 12-month expectation of around $42 per share. So we're seeing another 30% potential upside on the share price at this current point in time to get to the $42 price targets. So overall, Pembina is definitely an interesting company to take a look at for your portfolio. They currently have a yield of 6%, and if you're looking to add some high current income in the form of a monthly dividend payment, PBA is definitely a ticker to do some research into. Of course, the entire energy sector is pretty volatile as of late, and it has seen a major recovery to start this year. But if you want some high current income at this point in time and are willing to give up some long-term capital appreciation in the means, then definitely a stock worth taking a look at and speaking with a qualified professional about at this current point in time. And again, I just want to stress the point, when evaluating a pipeline company, don't focus on the net income payout ratio because that number is pretty deceiving. Right away, when you see 105%, it might scare you away from a company like Pembina, and I completely understand. I personally would not invest in a normal company that has a payout ratio this high. But if you understand the business and the specific sector, the payout ratio or the distributable cash flow payout ratio comes in at right around 61% at this current point in time, which is why the stock price and the actual dividend is considered safe from simply safe dividends. So definitely a high income producing asset to take a look for your portfolio at this current point in time. So I want to thank everyone who watched the video all the way up to the end. Please hit that like button and subscribe if you haven't done so already. Join the community, leave me a comment down below asking me any questions, and I will see you in tomorrow's video.